Welcome back to Tesla Daily News Podcast. Today is April 3rd, 2026. In the next few minutes, we're breaking down Tesla's first quarter delivery report, what it implies for margins and near-term earnings, fresh signals from Europe and China, and the big strategy debate, cars versus robotaxis, chips and robots, and what that means for TSLA's valuation. Story 1. Tesla's first quarter deliveries missed again, and the stock is reacting. Tesla reported first quarter deliveries of 358,023 vehicles. That's up about 6.3% year over year versus roughly 336,681 a year ago, but it landed below Wall Street expectations. Depending on the estimate you look at, analysts were around 365,000 to about 372,000, and some services were even higher. Context: deliveries are still the cleanest short-term read on Tesla's auto revenue trajectory. Tesla can talk robotaxis and Optimus all day, but the P&L is still mostly cars. Details: production came in higher than deliveries, about 408,386 built versus 358,023 delivered. For Model 3 and Model Y specifically, Tesla delivered about 341,893. Impact: the miss matters for sentiment because it's the second consecutive quarter that came in below expectations in multiple reports. When Tesla is priced like a high-growth platform company, even a small delivery shortfall can compress the multiple. And the production versus deliveries gap points to inventory build, often a margin risk if Tesla needs incentives or pricing to clear it. Takeaway: into earnings on April 22nd, investors should watch gross margin commentary and any sign that Tesla is leaning harder on price cuts or financing promos to move inventory. Story 2. The overproduction signal. Inventory build becomes the quiet margin killer. Hook: Tesla built roughly 50,000 more vehicles than it delivered this quarter. Context: in an ideal world, production tracks deliveries closely, keeping working capital under control. When production runs ahead, Tesla either stores cars, discounts them, or slows lines later. Details: across the quarter, Tesla produced about 408,000 vehicles and delivered about 358,000. That's a gap of a little over 50,000 units. Several analysts and outlets highlighted this as one of the biggest production delivery gaps in years. Impact: inventory build can pressure free cash flow. It also tends to raise investor questions about demand elasticity, especially now that the United States $7,500 EV tax credit ended in late September 2025, removing a major demand lever. Takeaway: if Tesla addresses the gap by throttling production, revenue can soften. If it addresses it with price, automotive margin can soften. Either way, the next 2 quarters become critical for proving stable demand without incentives. Story 3. Energy storage deployment fell. Watch this, because it's supposed to be the stabilizer. Hook: Tesla's energy storage deployment came in at about 8.8 gigawatt-hours, down from about 10.4 gigawatt-hours a year ago, and far below the record roughly 14.2 gigawatt-hours in the prior quarter. Context: investors increasingly want energy to grow into a material profit contributor that's less cyclical than vehicle demand. Details: this quarter's 8.8 gigawatt-hours is a sharp sequential drop from Q4's record level and a year-over-year decline. Impact: energy softness matters because it challenges the second engine narrative. If autos are pressured and energy isn't accelerating, the market will lean even harder on autonomy and robotics to justify valuation. Takeaway: listen for any supply chain or project timing explanation on the earnings call, because if this is demand-related rather than timing-related, that's a different story. Story 4. Europe is flashing a rebound in March registrations, good news, but it needs to stick. Hook: after a weak stretch in Europe, March data in key markets suggests Tesla may be regaining momentum. Context: Europe has been one of the most competitive regions, with legacy OEMs and Chinese brands intensifying pressure. Tesla also faced brand and political backlash risk tied to Elon Musk's public profile. Details: France saw Tesla registrations in March jump to 9,569, up about 203% year over year and just below a near 2-year high. In the Nordics, Tesla registrations rose sharply as well, Norway around 6,150, Sweden around 1,447, and Denmark around 1,784, with big year-over-year percentage gains reported. Multiple reports also pointed out that registrations often bunch at quarter end due to shipping and delivery logistics. Impact: if Europe truly reaccelerates, it helps stabilize global deliveries and eases the narrative that Tesla is structurally losing share. But investors should be careful. A quarter-end surge can be mix-driven, incentive-driven, or simply timing. Takeaway: watch April and May data. If registrations remain elevated outside the end-of-quarter spike, analysts will likely revise volume and margin assumptions upward. Story 5. China is still a battleground and competition keeps tightening. Hook. Tesla's China numbers show strength in some datasets, but the competitive landscape is getting fiercer. Context. China is Tesla's most important arena for volume and cost efficiency, and it's where competitors are innovating quickly on charging and new models. Details. One report cited Tesla China wholesale sales, including exports, at about 213,398 in Q1, up about 23.5% year-over-year. Meanwhile, BYD's first quarter totals included 700,000 plus EVs when counting plug-in hybrids and about 310,000 battery electric vehicles specifically, meaning Tesla likely reclaimed the pure BEV lead for the quarter, but the gap is not huge. Impact. The market cares about two things here: pricing power and product cadence. If Chinese OEMs win on features and charging speed while keeping prices aggressive, Tesla may have to choose between share and margins. Takeaway. China remains the key swing factor for 2026 estimates. If Tesla can hold pricing and still grow volumes there, that supports the bull case even as the US credit tailwind is gone. Story 6. Tesla is narrowing its lineup. Model S and Model X are effectively done. Hook. Multiple reports indicate Model S and Model X orders have effectively ended, with only remaining inventory available in some regions. Context. S and X are a small piece of volume, but they contribute to brand halo and potentially to mix and margin depending on pricing. Details. Musk posted that Model S and X orders have come to an end, and some reporting notes there are only hundreds of units left in inventory in the US. Tesla has discussed repurposing factory capacity toward Optimus. Impact. Strategically, simplifying the lineup can reduce complexity and focus resources on high-volume platforms. But it also reinforces that Tesla is not adding a new mass-market vehicle in the near term. That puts more pressure on Model 3 and Model Y and on the success of future products like Cybercab. Takeaway. Investors should model a more concentrated revenue base in the short run, and that typically increases sensitivity to pricing and competition in the mid-market segment. Story 7. Robotaxis aren't fully robot yet. Tesla confirms remote human intervention exists. Hook. Tesla acknowledged that in rare cases, remote assistance operators can temporarily take direct control of a robotaxi as a last resort. Context. Autonomy is central to Tesla's long-term valuation story. Any evidence that the system depends on humans, especially for safety-critical operations, can influence regulatory scrutiny and investor confidence. Details. Tesla described remote assistance operators who can step in when the vehicle requests help. In limited situations, they can assume direct control at very low speeds, around 2 miles per hour, and potentially up to about 10 miles per hour if the system permits. Impact. From an investor lens, the key issue is scale, economics, and transparency. If remote interventions are truly rare, it may be a reasonable safety layer during rollout. If they are frequent, then the unit economics and full autonomy narrative become more questionable, and regulators may demand clearer disclosures. Takeaway. Autonomy progress will be judged less by demos and more by operational metrics, disengagement rates, intervention frequency, and geographic expansion beyond early pilot areas. Now, a quick market backdrop, because it's moving everything today. Oil prices are spiking amid Middle East escalation and renewed uncertainty around the Strait of Hormuz. Broad risk assets have been volatile, and Tesla, like most mega-cap growth, has been trading with the risk-on, risk-off tape. Higher oil can help EV demand at the margin, but it can also weigh on consumer spending and raise inflation expectations, which is typically a headwind for high-multiple stocks. Before we wrap, here's what I'm watching next. First, Tesla's earnings on April 22nd, particularly automotive gross margin, free cash flow, and any guidance around production pacing after the inventory build. Second, April registration and sales data in Europe and China to see if March strength was sustainable. Third, any concrete disclosure around Robotaxi intervention frequency and expansion timeline. That's it for today's Tesla Daily News podcast. If you want this daily breakdown of the headlines that actually move Tesla's business and Tesla stock, subscribe and follow the show, and we'll be back tomorrow with the next round of Tesla Catalysts.